I acknowledge that I am hosting this webinar from the lands of the Gadigal people of the Eora Nation. I also acknowledge the traditional custodians of the various lands on which you all work today and the Aboriginal and Torres Strait Islander people participating in this webinar. Good morning all and welcome to our financial reporting update. My name is James Friend and I'm a director here at HLB Main Judd in our Assurance and Advisory Division, and I'll be your host for this morning's webinar. Today we have an action-packed financial reporting and tax update, which will be presented by our panel of experts, Jolyon Dare, Carmen Ridley and Michelle Warren. Joel is a highly qualified taxation practitioner. Through ongoing presentation to the members of the Tax Institute and the CAANZ, Joel is recognised as an industry thought leader due to his understanding of commercial tax matters. Without further ado, I'll hand it over to you, Joel, to start us this morning.
Thanks very much for that intro, James. I thought I'd talk about a couple of key tax topics which have emerged and probably most relevant to an audience that is looking at financial reporting type issues. And so there are four particular areas that I wanted to just touch on today, which match up with the new federal government and some of the new tax agenda that we're seeing as it applies to, in particular, a corporate audience. So the four things that I really wanted to run through in a little bit of detail today and just tease out some of the practical implications for taxpayers. First of all, to talk about thin cap, a regime that once upon a time we tried to work out ways in which it didn't apply or had no practical impact. Certainly with the proposed changes means that it will probably take up quite a lot more time and effort to comply with. The second one is to highlight an interesting concession which has been revealed in the most recent federal budget in October around providing concessional FBT treatment for, in particular, electric cars, and to highlight some of the anomalies with the opportunities and incentives that are available there. The third one is to highlight the possibility of extra tax deductions for training, which applies to a range of businesses which have been called small, but actually it's probably more widely applicable than you might first imagine. And finally, in particular for a multinational market for SGEs, that intangibles have been subject to renewed scrutiny and deductibility for payments that relate to intangibles to international related parties are potentially denied deductions. So those are the four areas I'd be touching on today. Thin cap. I thought I'd take a quick blast back to the past here. The existing thin cap rules kicked off in 2001, and certainly at that stage, I think we spent a lot of time with taxpayers working out two basic questions. Can I get out of these thin cap provisions altogether, because they're quite voluminous and difficult to read? And if you did have to actually do thin cap calculations to determine how much debt you could allocate to Australian operations, a lot of that was really just trying to work out what is the easiest way for me to ensure that I haven't got any debt deductions denied under the thin cap provisions. And a lot of the time, the easiest method that a lot of taxpayers would have applied if they were unfortunately within the potential application of the thin cap provisions was to use what we call the safe harbour method, which was really comparatively a great deal more concessional back then compared to where it is, or it had been up until this most recent announcement. It allowed you up to 75% gearing. Fast forward to today, and we've seen over a period of time both the concessionality of the thin cap provisions and a range of different options that are available to ensure that you would not lose any of your interest deductions as a result of having excessive debt allocated to Australia. We've seen a lot of that concessionality removed through removing some of the options that were there around revaluing assets, a reduction in the safe harbour permissible debt from a 3:1 to a 1.5:1 ratio. And a gradual reshifting of the worldwide gearing and arm's length debt tests. Now, what's changed in particular in this most recent announcement by the incoming government is quite a radical shift which is proposed in relation to thin cap. For 80% of taxpayers who up until now will have relied on the safe harbour method as being probably the most stable and objectively easy to, I suppose, get some assurance around, though that regime will change very substantially. And the key takeaway from what that change is is that while we got used to measuring the amount of debt that could go into Australian operations through analysing your balance sheet, now it's proposed to go to an earnings-based methodology. That is, it will allow a proportion of EBITDA in each particular year. And the thing that I think I see as being the potential risk or hazard for management for finance teams is that inherently EBITDA is a much more volatile measure, and therefore 30% of EBITDA is a much more difficult measure for a lot of taxpayers to gain assurance of, that they're not going to, for example, lose their deductions altogether if they have a loss year. And so from that perspective, I can see that a change to an EBITDA-based calculation of a safe harbour amount of debt will have quite a few flow-ons there. The other two, I suppose, subsidiary means that people use to ensure their compliance with the thin cap regime have also changed, and they are, if you've ever had to visit them, the arm's length debt test, which basically analyses the level of debt that would be permissible from a lender's perspective, and also the appropriate level of debt to maintain from the entity's perspective and still have a sufficient return for equity holders. Now, that arm's length debt test is proposed also to change, and the change would be to actually remove the ability to claim deductions for related party debt. Now, that arm's length debt test had become a lot more prominent as the concessionality for the safe harbour method had gradually been whittled away over the last 10 years. And finally, the worldwide gearing debt test is also proposed to move to basically an analysis of the relative cost of debt across a worldwide group and what proportion that is in relation to EBITDA. And then, for example, if the worldwide ratio of interest or debt deductions to EBITDA globally was, for example, 38%, then Australia similarly would be allowed a 38% rate of interest deductions. So look, some of the practical things that I see coming out of this are that the EBITDA methods of testing thin cap means that, especially if you're looking at an assurance situation, it will become quite a lot harder to get a lot of these issues sorted out before you actually finalise your financial statements for a particular year. Also, I suppose one concessional thing that I see coming out of these thin cap changes is if you do have to move across to an earnings-based assessment of thin cap, previously you'd be aware that thin cap denial of deductions was effectively what I would call a permanent difference. You not only didn't get it that year, you never got it in any other year. Now, what would be proposed to change under the new provisions is that potentially if you miss out on getting a deduction as a result of the earnings basis measurement of safe harbour, the amount of the denied interest deductions actually can be carried forward for a period of 15 years. And so you've sort of got that interesting interplay there where, previously it was nice and easy. You had an instant income tax expense charge if you're recognising income taxes in your financial statements. Now, I suppose the question will arise, potentially that's a deduction that you might be able to get in the future. And so there's a range of subjective issues that you'd need to think about as to whether or not you're having an income tax or a deferred tax asset impact as a result of missing out on deductions under the EBITDA methods. Okay, look, that's not quite enough about thin cap this morning. So now just to look at something, I suppose, a little bit more straightforward. Extra deductions for external training costs announced in the most recent budget, federal budget. It applies what they've described as small businesses. And the thing I love is when you talk about small businesses for tax purposes, there seem to be about 5 different definitions, and it really depends on what type of small business we're looking at. And I wanted to bring this one up today because the definition of small business for these extra deductions actually encompasses businesses that have a turnover of up to $50 million. And so I suppose that's quite a reasonably large sector of a component of the Australian economy that may potentially qualify for these additional deductions. So what is it? Look, the punchline is that if you meet all the various criteria that are set out here, in addition to the basic deduction for the amount incurred, that you also get access to an additional 20% deduction. So it's instantly giving you, I suppose, a reduction in your potential income tax expense and tax payable. Now, I just thought I'd set out some of the key criteria that are involved there. It will only be around until the 30th of June 2024. It has to be external costs, and also it has to be costs paid in relation to what's referred to there as a registered training provider. So that's an important thing to keep in mind. The turnover definition, it's an aggregated turnover, means not just the tested business, but also any associated business, which generally means anything that has a common interest of 40% or more with the entity that's incurring the costs, or anything else that controls the entity. So you have to aggregate all of those entities to determine aggregated turnover. And so the other slight anomaly here, I suppose, or planning point might be, it's a deduction which is only really available to an employer that's conducting a business. So we've got a bit of an anomaly there between, for example, an employee incurring their own costs, clearly is not a business, clearly is not entitled to these deductions, versus costs that are incurred through the business. And so for that reason, I think it's probably a significant difference and a planning point there, that those type of costs really do make much more economic sense being incurred by the employer, even to the extent that that has to be, I suppose, reimbursed in some way. Another concession that I thought I'd highlight here, which also basically is unique to the employment situation, and that is the announced measures in relation to FBT exemptions for essentially electric cars. Again, it's a measure that only operates through the FBT system, and where you do have an eligible vehicle, that vehicle and all of the associated costs with that vehicle will actually not be subject to FBT at all. And there's a couple of different key points to note around accessing this benefit. It can't apply to something where the employee buys the car individually. It has to be a car that's held for FBT purposes by the employer. It will only apply to cars that are purchased new after the start date, which I believe is the 1st of July 2022. And that it applies to a class of cars there that I've set out there. The primary one would be battery electric cars, but it also will apply to hydrogen cars, of which there are just a few, I believe, in the country at the moment. And for a period of time, it will also apply to plug-in hybrid electric vehicles, or PHEVs. But as a result of an amendment which went through, those cars would only qualify for the FBT exemption if they're actually provided to the employee before the 1st of April, first provided to an employee before the 1st of April 2025. Now, if you are in that type of situation, it doesn't actually mean that the exemption switches off once we get to the 2nd of April 25. If the car is first provided before that time, it will continue to be an exempt benefit after the 1st of April, provided it's originally provided before the 1st of April 25. The other key thing to note is there's actually no point trying to go out and get that Ferrari plug-in hybrid electric vehicle. That's not going to work. I was going to suggest that as one of my tax planning tips for year end, but unfortunately that's not going to work. It has to be a vehicle which is less than the luxury car tax threshold, which for low emission vehicles, anything that has less than 7 litres per 100 consumption of fuel, that is actually set out there as $84,916. So if you are looking at a car that has luxury car tax impost, it cannot qualify for the FBT exemption for battery and plug-in hybrid cars. The other thing is also to note that it will only apply to a new car. That is, you can't, I suppose, have a second-hand car to apply these particular benefits. And the policy reason here is an encouragement for, in particular, employers to take up electric cars, but the point being that it should encourage the supply of new electric cars, and with the idea being that that ultimately will flow on to consumers once those cars are turned over by fleets and ultimately purchased by private purchasers. Now, the last point I wanted to touch on today was something that really applies to significant global entities. And those are ones where, together with your international related parties, you have a turnover of greater than $1 billion Australian dollars. And that's determined on a financial accounting basis. So if you have or would prepare consolidated financial statements that would have turnover or revenue exceeding $1 billion, then you are an SGE. Now, what do these measures do? They really look at the subject of where you've got a payment in relation to intangibles. So because it's an announcement at this stage, the detail on that's a little bit scant, but a payment in relation to intangibles could relate to a whole bunch of different things. It could be licensing, it could be a traditional royalty, but it's basically something where you would otherwise claim a deduction for a payment to a non-resident associate for some payment in relation to intangibles. Now, it's not a denial for all payments for intangibles to non-resident associates. It's just two categories here. If the recipient of that payment for intangibles is in a less than 15% tax jurisdiction, then the denial will apply to that situation. But it will also apply to a situation where, even though you're not in a tax jurisdiction with less than 15%, the recipient of the payment for intangibles is participating in a patent box regime and doesn't have the sufficient physical presence within that particular jurisdiction. So those are the two key issues to watch out for there, because in those situations you can have a denial of deductions. Now, one thing that I think will be very interesting is that there's a discussion that the denial of deductions for payments for intangibles can apply to what they call direct or indirect payments, which would make it quite difficult in a lot of cases for an entity that's operating within Australia and its finance teams to understand whether or not a payment for intangibles can ultimately flow through to one of these concessionally taxed regimes. And it does put a significant onus every time one of these payments for intangibles arise, I suppose, to prove that economically speaking, the payment for that doesn't ultimately end up in either a low tax rate jurisdiction or in a patent box regime. Thanks very much. I might pass it back to James to introduce Carmen and Michelle.
Thank you, Joel. I would now like to introduce Carmen Ridley and Michelle Warren. Carmen Ridley is a member of GAP Consulting Network and a principal of Australian Financial Reporting Solutions, and specialises in financial reporting advice, accounting standards interpretations, technical training and financial statement reviews. Carmen has an excellent knowledge of financial reporting through significant experience with several major accounting firms in both external audit and technical divisions, and spending time analysing and interpreting Australian accounting standards for clients. I would also like to introduce Michelle Warren, who is our National Financial Reporting Director at HLB Mann Judd. Michelle provides leadership on financial reporting matters across the Australasian network. This includes overseeing the network's thought leadership on financial reporting issues and developing and delivering training to meet the financial reporting needs of our network firms. Without further ado, I'll pass over to you, Carmen.
Excellent. Thank you, James, and welcome everyone. I guess if I'm just going to run quickly through the agenda that Michelle and I will talk to you about, I'm going to start with a few contemporary issues. So effectively what has been keeping me busy for the last 6 months, because often I get some really common issues that occur, and I thought it was worth just having a chat through those. We're then going to have a look at what our corporate regulator has been up to in that what has ASIC actually put out. Then I thought it's useful, often I'm asked about what's coming. So we say that there's not a huge number of changes for this year end around accounting standards, but does that mean that the IASB and the AASB are stacking everything up ready to release them all? They've actually both just gone through an agenda consultation period and are telling us what's on their work plan for the next 4 years. So I thought it was worth just talking about that. So a bit of a watch this space, you can see what's coming. I'm then going to finish with a bit of a sustainability update around, again, what I'm seeing around some of the questions and around what we need to think about in relation to accounting standards. Michelle is then going to finish off with talking about a new standard that's been released, some changes to the Corporations Act, and some disclosures that need to be thought of for the for-profit entities, as well as finishing off with a bit of a not-for-profit update. So let's get into the detail. Just the normal disclaimer, this is obviously just for training purposes. So let's start by looking at some of our contemporary issues. By far, the biggest lot of queries I have had over the last few months have been in relation to control and consolidation. So I thought what I would do is go a little bit back to basics. So bear with me as I talk through this process. And maybe the slightly cynical side of me will give you the rationale on why I think I'm getting so many queries on control and consolidation. So we have an entity that is a parent, and a parent entity is defined as somebody who controls an investment. So regardless of the type of entity, if you control something, you are deemed to be a parent. Now, when we think about control, we're very much in the definition that's in ASB 10. It does not matter what type of entity you are. So the definition of control is we need to meet three components. The first is we have to have power. The second is we have to have exposure to variable returns. And the third is that we have to be able to affect those returns because of the power that we've got. So there's no discussion in there about, do you own 50.1%? There is no bright lines at all within this standard. It's those three elements. Do you have power? Do you have exposure to returns? And do you have the ability to affect them? So when we talk about control, that's what we need to bear in mind. So once we've determined that we do control an investment, we then have to present consolidated accounts. And if you are preparing general purpose accounts, consolidation is required. There is no option to not prepare consolidated accounts. So this is where my slightly cynical side comes in. And the reason I think I'm getting so much questions on control at the moment is because, as Michelle and I have talked about numerous times over the last few of these sessions, there are a significant number of entities who are no longer able to prepare special purpose financials. So any entity who is lodging with ASIC, any entity who has got certain words within any of their constituting or other documents. Previously, entities could say that consolidation was a presentation standard and choose not to comply with it. Now, if you have to do general purpose financials, you don't have that option. You have to consolidate. So what it's done is force a lot of entities to say, well, let's have a look at our group structure. Let's have a look at entities we're involved with. And what situation do we have? Do we control them or do we not? Now, the next thing I'm going to talk about is, obviously the word has gone out somewhere that there is an exemption within the standards around consolidation. And that is to do with investment entities. So this investment entity exemption was something that came out back in 2012. And to give you a little bit of a background to it, the international board wanted Canada to join the international regime. And the Canadians looked and they said, look, we're kind of, we're semi on board, but we've got this big group of entities in Canada called investment entities, and they're governed by a very specific act in Canada. Under that act, those entities do not have to consolidate. If we join the IFRS regime, those entities would have to consolidate, and they're not very happy with that. So consequently, this exemption was written. The international board couldn't obviously say it only applies to these Canadian entities covered by this act. So they had to come up with some definition. Now, I was on the board when this was discussed. It was the most controversial discussion that we had at the board. We had, I think, 3 dissenters. If there was one more dissenter, we would have broken IFRS compliance with this particular standard. So they really did not want to be issued within Australia, but it came out. The idea of this is for your private equity firms, your venture capitalists, your major superannuation funds, who what they are doing is buying and selling entities. So I'm buying an entity, I could break it apart and resell it, or I'm buying it because I think it's actually a really good investment as a startup. It's going to grow, hopefully. Then when its fair value is increased, I have an exit strategy to get rid of it. That's the intention for this exemption. The reason I'm talking about it today is, as I said, this was issued back in 2012, 2013. I reckon between that date and 6 months ago, I maybe had 3 queries on this. In the last 3 months, I have had probably 10 to 20 queries on this because entities have gone, great, this is a way we can avoid consolidation. Let's pretend we're an investment entity. It is really quite strict criteria. There is lots of guidance within the standard. So I've included the definition here. But it is very rare that entities can use this. As I said, it's aimed at your venture capitalists, your private equity firms. So I wanted to talk about it just to effectively, hopefully, draw a line in the sand with this in case any of you had heard about it or are seeing any entities do this. So I'm off my soapbox now on investment entities. So let's move on and see some of the other queries I've had around control. Trust versus trustee relationships. So we have a number of trust setups within Australia, and it was often set up, and we've got obviously Joel on the line, often trusts are set up for tax purposes. For accounting purposes, we tell you you have to account exactly the same way, but they're often set up for various reasons. It also allowed non-transparency. So if you are a trust, you are not governed by the Corps Act. However, you also lose your limited liability. So what most trusts do is set up a corporate trustee. That corporate trustee is governed by the Corporations Act, and in most cases they are set up as proprietary limiteds. So when we've moved to that general purpose regime, all proprietary limiteds have to determine whether they are large, and if they are large, they have to lodge. If they lodge general purpose accounts, which involves consolidation. So what we need trustee companies to be doing is to determine whether they control the trust. If they did, and it's a significant trading trust, it could trigger them into being a large proprietary company, and they would have to lodge consolidated accounts, which means that you lose your transparency of not lodging the trust financial information. So this is something, again, we have talked about it over the last few years when this came out. I'm getting a huge number of queries. I have also spoken to at least 2 regulators about this issue when they are starting to see that this is potentially a concern, where the trustee companies are still lodging $2 accounts and saying that they're not consolidating. So I'm not necessarily giving you a blanket answer that all trustee companies do control the trusts, but I'm certainly very, very strongly encouraging you that if you are running a trust and that trust is large under the Corporations Act rules, you need to have some good documentation about that trustee-trust relationship. The next issue is around reverse acquisitions. Now, it's not something that I love getting queries on. In fact, whenever I get a query, my heart kind of drops because they're never easy calculations. And I'm just raising it today because I've seen, again, a number of these. So this is where we have little entity, and little entity is often a shell entity that could have been set up, or it could be a shell listed entity. Little entity legally acquires big trading company. For accounting purposes, we generally say little entity cannot be the acquirer, particularly if little entity has issued shares to acquire big entity. So every time that situation arises, we need to be thinking, is this a reverse acquisition? Because it may be, and in which case you flip the accounting. So for accounting purposes, the legal acquiree is actually the accounting acquirer. So this is more just to raise awareness of. The next one, and apologies, it should say common control, not common controls, is where we are seeing a huge number of group restructures. So we then insert a shell entity somewhere else. So we had a group and we've rejigged all of our entities, but effectively the same people controlled them beforehand as did afterwards. If that is the situation, you don't do a normal business combination. There's different things that you need to consider. So I just wanted to put these in because if you are undertaking any of these weird and wonderful transactions, they're often not normal at the accounting output. So just something to be aware of. The last question that I get on control is, I have an X type of entity. How do I know if they control Y? It does not matter what type of entity it is. The control definition is exactly the same for every definition. So that for every entity rather. So that one I put up 2 slides ago, it's exactly the same definition. And that's what we really need to come back to. And I spend lots of time saying to people, it does not matter. This is the control definition. Is there power? Is there exposure to variable returns? And do you have the ability to affect those returns? So that's, as I say, that has kept me busy so much these last few months. I don't remember a period, even when the new standards came out, that I've had so many queries around control and consolidation. So I wanted to just highlight that to you. So let's see what else has been happening in the financial reporting query space. Convertible notes. This seems to have been the thing this reporting period, and whether it's to do with the fact that interest rates are rising and therefore this is an alternative to just your traditional bank borrowings, I don't know. There has been a massive number of convertible notes issued. So lots of queries. What we generally find is that people spend a lot of time thinking of the tax implication, and people spend a lot of time actually thinking of the mechanics of how the convertible notes would work. What they don't think about is what the accounting is going to be. And we often see that that's not even considered until the convertible note deed is signed, sealed, and delivered. And in many cases, people do not like the answer, because often what we end up with is a very large liability on the balance sheet, whereas people often think that it's equity because it's to do with issue of shares. So I'm encouraging you in this space, if you are even vaguely dreaming of maybe I'm going to issue some convertible notes, please check the accounting of those before you actually really get into the detail of those. Revenue is the standard that just keeps on giving. The number of queries, again, that we keep getting on revenue. And what I'm starting to find now, so revenue in the for-profit space has obviously been around for a few years, but people are changing jobs. And I'm seeing that people are coming into a new job as a new CFO and looking at the revenue recognition policy and going, that doesn't seem to make sense. That doesn't seem to be in accordance with the new revenue standard. Or I'm seeing auditors are changing. And again, the auditors are picking it up. So it seems to be that's where a lot of the queries are being driven from. I've had a number of queries on principal versus agent. And again, some of those have been driven by the fact that we now have large proprietaries who have to lodge general purpose accounts. So maybe entities are looking to say, am I really the principal in this? Should I really be recognizing gross revenue? Or am I actually the agent, which means my revenue drops dramatically and maybe I'm no longer large? So I've been seeing a few queries around that, and then just lots of different revenue queries. I started off listing them all out and then my box just got very big. So just lots and lots of revenue things. So whilst we are in this period of very little standard change, I would encourage you to just take that step back, look at your revenue recognition policy, just check that it actually complies with the standard and you've documented it really well. So if you were to change jobs, there is that understanding of how your methodology works. Interestingly, this year, I've also received quite a few queries on the events after the reporting period. So what is that? How do we actually deal with those? And often, I guess, ignorance maybe that we do have to adjust a number of these events. So we're very good at disclosing. We're very good at saying, oh, all this happened after the reporting period. But we have to actually look back and say, well, what was the situation? Was the condition in place at the year end? And even though the crystallizing factor may not have happened till after the reporting period, we may actually need to go back and readjust the numbers. And I've had a few of those with really last minute adjustments to the financial statements, which is not where anyone wants to be. Because as you all know, if you change one number, it mucks everything up and your whole financial statements. It takes a really long time to do that. So whilst we're at the 29th of November now, any of you who may not have signed your accounts or December year ends who are coming into that January period, just be aware, what process have you got in place to identify any events after the reporting period? If I was to ask that question to a group of auditors, they would describe a really detailed process that they go through to check for events after the reporting period. When I throw that same question out to preparers, there's generally a bit of squirming and there's not necessarily a process in place to identify these events. So the earlier you can identify them, the easier it is to deal with them. All right, the other area I just wanted to talk about is a disclosure that we often see that is not great in the financial statements, and that is around the judgments and estimates. So we are in an environment at the moment that it seems to be changing almost on a daily basis. And we are making huge amounts of judgments and estimates around what future interest rates are going to do, what inflation is going to do, what is going to happen with the conflict in the Ukraine, what is going to happen with COVID. There is massive amounts of estimation and uncertainty in the world that we are living in today. So a reminder that we do actually have specific disclosure requirements around this. And the idea behind this disclosure is to say there is uncertainty. When you put together your financials, there is uncertainty. So therefore, tell the users of your financials what they're going to be. We have this blanket requirement, so in AASB 101, which covers off a general. Tell me all of the significant judgments and estimates. And you can see the disclosure requirements really are split into the two. And then the more recent standards do have specific disclosure requirements around this area because the International Board acknowledged it was done so badly that they wanted to highlight within the standards where there were particular requirements. So for example, AASB 15, our revenue standard, it gives you some areas of judgment. AASB 12 is around the control standard. So just look at your judgments and estimate disclosure and just make sure it is reasonable. So if we look at what I actually often see in financial statements, I see these comments. I see a comment that says management has made significant estimates and judgments in preparing these financials. And what I write if I see that is, I know you have, tell me what they are, because that statement doesn't help me, doesn't help the user. We see a comment that says the estimates and judgments made in preparing these financials have been included in the relevant note. Fantastic, great. It's where I think it should sit. But make sure you've actually put something in the relevant notes about the estimates and judgments, because what I often see is that statement up front, and there's nothing in any note that tells me about estimates and judgments. The third thing I often see in my bad list of things I don't want to see is a boilerplate list of every potential judgment and estimate. So somebody has grabbed the model financial statements and just written that list. Model financial statements are a great tool. I write some myself, but they are written by techies to illustrate every circumstance in this particular scenario. So don't tell me about impairment of goodwill being a really significant judgment area for you if you do not have any goodwill. Don't talk to me about your useful life of your property, plant and equipment if the property, plant and equipment balance is so immaterial that it really cannot possibly be judgment and estimate. So again, we're in a period of not much change in the standards. So I'd encourage you to have a look at these notes because they are really important ones. So let's have a look at what ASIC has been up to. We've talked in previous sessions about some fines for non-lodgement of financial statements, and we are seeing more and more of these happening. So I haven't put a big list of every entity because it would probably take up a couple of slides, but interestingly, the fines are also increasing. So it depends on the entity, and I can't tell you why some entities get much lower fines than others. So the latest media release, the penalties varied from one company that got a $1,000 fine with a 12-month good behavior bond, and another entity got a $50,000 fine. There were the same number of financial statements that they didn't lodge. So I just wanted to highlight this. I'm sure that everybody listening is lodging their financial statements on time with their regulators as they should be. But I do hear that entities say the fines really aren't very big, so I'm not going to bother. I'd rather my information wasn't made public. The fines are starting to increase. So just be aware of that. The next thing is we have had our first greenwashing penalty in Australia. So ASIC have imposed, they issued 4 infringement notices to an energy company. That energy company in its ASX announcements had announced that one of their overseas plants was going to be carbon neutral. They did not have the evidence to support that statement. So ASIC went in and said, that's great, your investment presentation looks beautiful, but where's your support? And they paid the penalties. The penalties in total were $53,000. Again, it's not a massive number. It's not a number anyone wants to pay. So just be aware, make sure that any green statements you make are factual, not aspirational. We've also had some clarification on some AFSLs. So hopefully anyone who's in that space is aware of that. Was a little bit of a mess, the whole AFSL thing, but a little bit better now that we've got some clarification. And I also just wanted to raise the fact that ASIC is starting to compile a number of FAQs around the financial reporting and audit space. It's not their role to interpret accounting standards, so they don't do that, but it's getting to be quite a good resource, and they're going to keep adding to that. So it's a good place to go if you have some queries that you think maybe ASIC may have the answer to. We have a look now at the misstatements that ASIC have been coming up with. They did tell us back in June that their focus was going to be around disclosure of material business risks. And that's really come through with these restatements. So you can see in that other section, we have 2 entities who have been pulled up because ASIC did not believe that their material business risk disclosure was appropriate. Didn't change the numbers in the financials. There was no adjustments to that, but is something that ASIC are focusing on. So the listed entities who are listening, just be aware, something to consider. The only one that actually did change the numbers was on the old favourite of impairment, which shouldn't be a surprise to anyone. And that was around goodwill and plant and equipment. So certainly, definitely something still on the radar, particularly with the economy the way it is. And obviously, the higher the interest rates, the more we're discounting cash flows, which means that there's more chance that there are impairments that are occurring. So let's have a look now at what is on the agenda of the standard setting boards. So as I mentioned, both the boards have recently undertaken an agenda consultation, which is exactly what it says it is. It is effectively where they go out to the world and say, tell us what you want us to do. So what came back from the international one is that there is nothing major that is happening over the next 4-year period. So good news for the preparers who are listening. The board is going to undertake a post-implementation review of the major standards that we have just been through. So financial instruments, revenue, and leases. And the idea of that is to say, are these standards giving us the answers that we thought they were going to give? There may be major change from those. There may not be. The international board will go out globally for comments on those. Their projects that they're going to work on is intangible assets. Now, they have just recently voted that for goodwill, they will continue to use an impairment model. So they are not looking to go back to amortization of goodwill in that intangible space. But also in that intangibles, they are not doing a separate project on crypto, but they have said that when they look at that intangible asset standard, they will look at assets that are out there that would now meet the definition of intangibles and see whether that standard is fit for purpose. Their other major focus area is the statement of cash flows, and we may see some changes around classifications within that. They have created a couple of reserve projects in case they finish all their work well ahead of time and don't know what to do. I would be shocked if they get onto those, but you can see that those on the slide. They're then going to keep working on educational material, keep doing the minor amendments, and have added to their agenda a project on climate-related risks. Now, this is in conjunction with the International Sustainability Standards Board, because they don't want to conflict into that space. It is a sister entity to them, but this is going to be more of a short-term, narrow project to see, do we need to do anything now? And why are investors telling us that climate-related risks are not being adequately disclosed? IFRS for SMEs is a major project for the international board, not such a major project in Australia because we do not use it, apart from we use the disclosures as our basis for our tier 2 general purpose financials on that one. They are also starting to look at digital financial reporting. It is not an area that I know a lot about, and I know it has been talked about for a number of years, but I think we're starting to see more of this getting some impetus, particularly around the sustainability field at the moment, that if we can do things digitally and we're not having to keep printing out lots of reams of paper and people can get the information they want, maybe that's the way to go. The middle one, hopefully, is a big project, but I'm not sure that we're going to see a massive change in understandability of accounting standards. I'm not sure they're just going to completely rewrite them all, make them all plain English and much easier to understand, but certainly they are looking at it. And then that stakeholder engagement where they're out there trying to talk to people. So again, as I say, nothing major is coming over the next few years, which is hopefully good news for you. From the AASB perspective, they will continue to work with the international board and obviously link to there. But you can see that the AASB is looking very much at sustainability. And there was a Treasury consultation that came out yesterday that is proposing that the AASB will be the standard setter that deals with sustainability in Australia. So very much a major focus for them. They are also doing some work on intangibles, doing some work on going concern. You can see at the bottom of the slide, there were projects that were sat dormant on the AASB agenda, and they've been taken off based on the recent agenda consultation. So the frameworks around not-for-profit, any of you are in the not-for-profit space that Michelle will talk about, is also a major project for the AASB. So I just want to finish off by talking very briefly about sustainability. And in the context of, there's lots of discussion at the moment around these ISSB standards, and, you know, they're coming out and they're going to provide all these disclosures. It hasn't yet been determined whether we will adopt them within Australia, but at least it will be a framework. So lots of people are saying, well, that's great, I don't need to do anything on sustainability until those come out. So a question for the audience that I'm not going to get you to type in, but to think about, are there any requirements at the moment to account for and disclose any sustainability issues now? So if we think about that, and then you can shout out your answers to your screens because you're all on mute. And then let's have a look at what my answer would be. The term climate change, climate risk, does not appear in any international standard or Australian standard. But does that mean we can ignore it? No, it doesn't, because our standards are principles-based. So they're deliberately principles-based to try and deal with future proofing. So if we look at what we do we need to disclose, we can work out that we've seen that we have to talk about judgments and estimates. We are making judgments and estimates around climate risk. We are potentially seeing climate risk impacting what our impairment disclosures should be. So anything that this could be an impact on, useful lives of property, plant and equipment. If we are using plant and machinery that is churning out all sorts of yucky stuff, probably does not have the useful life that we initially thought it was. So whilst it's not explicitly addressed, it is absolutely implicitly addressed in the assumptions that we are making. So I talked on the previous slides about the IASB has added climate risk to its agenda. The feedback that it got was that there is inconsistent application and insufficient information. So what the International Board are doing is trying to work out why that's the case. Is it that we need, excuse me, more time to implement and start thinking about climate risk? Because this has gone from 0 to 100 in not very long. Or is it behaviors? Or is it something else? So we may well see some more guidance explicitly highlighting some of these areas. The International Board did put something out on which standards could be affected by this. So if we have a look at the materiality, and we think about materiality in the context of sustainability and what do we expect to see? I've actually stole this from the AASB EUASB document on climate risk. So I recommend that you have a look at there. And I think the question at the start is really important. If you are in an industry that your users would expect climate-related risks to have a significant impact for you, then you need to do something about it. So for example, if you were working in a construction industry, if you were working in a mining industry, climate-related risks could be really important to you. Or your investors could think it. And you might have looked at it and said, we've looked at it, we really don't think it's a big issue. But that's not what the question is. The question is, would your investors expect it to have a big deal, an issue for you? Would it be a big deal for you? And if they would expect, because everybody else in the industry is disclosing it, then we're flicking into, you probably need some disclosures to talk about what you've done, to talk about, has there been any impact? To talk about the assumptions that you've made. So this document was issued a couple of years ago now. This is not a brand new document. So the boards are telling us we need to make sure we are considering any particular assumptions we've made around this climate-related risk. That was all I wanted to talk about. So I am going to hand over to Michelle, who is going to take us through a number of other financial reporting matters.
Thank you, Carmen. Lots of food for thought. I'm going to get straight into what's new in the accounting space. Carmen wasn't lying. There's really not much happening. The changes I will talk about are the international amendments relating to the classification of debt as current or non-current. Now, what was supposed to be just a few amendments to clarify certain requirements relating to liability classification turned into a bit of a 2-year saga. I've tried my best to condense this 2-year saga into 2 or 3 slides by focusing on the amendment that caused all the excitement in the first place and how this has recently been resolved by the International Board. So the standard in question here is IAS 1, the standard about presentation of financial statements. Here in Australia, it's known as AASB 101. This is the standard we refer to when assessing whether a liability should be classified as current or non-current, a concept that most entities are familiar with. Now, back in 2020, IAS 1 was changed by adding a bit of guidance to assist entities with this current, non-current assessment. These amendments didn't change the requirements of IAS 1, they just clarified them. As we all know, to classify a liability as non-current, you must have the right to defer settlement of that liability for at least 12 months after balance date. One of the 2020 amendments clarified how an entity determines whether it has such a right when that right is subject to compliance with specified conditions, also known as covenants, within 12 months after the reporting date. Applying the 2020 amendments as they were initially written meant that such a liability could only be classified as non-current if the entity complied with those covenants based on circumstances as at the reporting date, even though compliance was required only after that date. The best way to demonstrate the practical implications of this amendment is to show you a simple example on the next slide. So take a 5-year loan that has a covenant requiring a working capital ratio of more than 1 at 30 June 2022. If this ratio is not met, as at 30 June 2022, the loan becomes repayable on demand. At 31 December 2021, which is the company's year end, the working capital ratio is 0.9 based on year end numbers. Applying the 2020 amendments as they were originally written, the loan would have to be classified as current at year end because the working capital ratio is not met, even though compliance is only required in 6 months' time on 30 June 2022. Now, as you can imagine, stakeholders were very unhappy with this outcome, and I've put some of the reasons on the slide. So the issue was escalated to the international board, who agreed with the stakeholder concerns. And as a result, just last month, amendments to fix the initial amendments to IAS 1 were issued, and we'll call these the 2022 amendments. So if we move on to the next slide. So under these 2022 amendments, a liabilities classification as current or non-current is based on compliance with covenants or specified conditions required only on or before the reporting date. So going back to the example on the previous slide, the 5-year loan would be classified as non-current at 31 December 2021 because compliance with the working capital ratio is only required and will only be tested in 6 months' time on 30 June 2022. But the company will have to disclose additional information in the 31 December 2021 financial statements, and that's to help users assess the risk that that loan could become repayable within the next 12 months. Things like the nature of the covenants and when they need to be complied with, the carrying amount of the related liabilities, and any circumstances that indicate that the entity may have difficulty complying with those covenants. And these disclosure requirements are new and have been introduced by the 2022 amendments. I'm not going to go through this slide in too much detail. What I've tried to do is summarize both the 2020 and the 2022 amendments for ease of reference, should you be interested. The change in the 2022 amendments column, those are the ones I've discussed on the previous slides. All the amendments, both 2020 and 2022, become effective from 1 January 2024. And you can early adopt them. You just have to adopt both lots of amendments at the same time. The 2022 amendments have not yet been issued in Australia, but my understanding is they will be issued here at home before Christmas. All right, for the financial services licensees listening today, after much confusion and ASIC firming up requirements in the revised Form FS70 pretty late in the game, hopefully you're all aware of your new reporting requirements. If not, that's okay. I'll quickly run through some of the changes and the transition requirements or the transitional relief at a very high level. So AFSLs can no longer prepare special purpose financial statements. And that's because AFSLs have a legislative requirement to prepare financial statements that comply with Australian accounting standards, which then puts them in scope of the reforms that saw the end of special purpose financial statements for many for-profit private sector entities. Whether an AFSL prepares Tier 1 or Tier 2 general purpose financial statements depends on whether the licensee has public accountability as defined in AASB 1053, or is deemed to be publicly accountable by ASIC. And you can find the list of licensees that ASIC deems to be publicly accountable under the certification section or section 11 in the updated Form FS70, which I've just snipped up, I've popped it there on the slide. So licensees with public accountability or are deemed to be publicly accountable by ASIC, they must prepare Tier 1 general purpose financial statements to meet the reporting requirements. All other licensees, they can prepare Tier 2 financial statements applying the simplified disclosure framework. There is no option for special purpose accounts. In terms of transitional relief, it's really only those licensees that report only under Chapter 7 that have been granted optional transitional relief. So if you report under Chapter 2M and Chapter 7, what I'm about to say does not apply to you. There's essentially no relief for you. Where you are a Chapter 7 only licensee that is not a reporting entity, and you prepared special purpose financial statements for the immediately preceding year. So for December reporters, 31 December 2021, you can choose to defer preparing your first set of general purpose financial statements by 1 year. And ASIC has also granted comparative relief, which means that Chapter 7 licensees can transition to the appropriate tier general purpose financial statements over time. So in the table, I've shown what applying the REIF will look like over 3 years if you are deemed publicly accountable and if you're not deemed publicly accountable. And remember that using the relief is optional. You can also elect to immediately start preparing general purpose financial statements, in which case you can still make use of the comparative relief that ASIC has afforded. So for a 31 December reporter, 31 December 2022 would be Tier 1 or Tier 2 general purpose accounts, whichever is appropriate, with special purpose comparatives. And then for 31 December 2023, it would be Tier 1 or Tier 2 general purpose accounts with the same tier comparatives. All right, this is more of a reminder slide, as we have covered off this quite a bit in the last few months, and also including our May updates. The extra disclosures apply to those for-profit private sector entities that are allowed to continue to prepare special purpose financial statements because they're constituting or other document that requires financial statements in compliance with Australian accounting standards was created prior to 1 July 2021, and it hasn't been changed since that date. So think of a trust with a trustee that's pretty old, hasn't been changed or amended after 1 July 2021, and it requires preparation of financial statements in accordance with Australian accounting standards. Even though that trust's reporting requirements require compliance with Australian accounting standards, it gets to continue to prepare special purpose financial statements, but it will then have to include these extra disclosures in its financial statements. And this is to ensure that the basis of preparation is really clear, where a special purpose report refers to compliance with Australian accounting standards. The disclosures will continue to be made for as long as the requirements to prepare financial statements in accordance with Australian accounting standards remains in the trust deed, and that trust deed doesn't change. In case you're interested, these disclosure requirements are set out in amending standard AASB 2022-4. All right, the grandfathering regime came to a very abrupt end in August, catching many of us unawares. In case you didn't know, since 1995, large proprietary companies that met certain requirements that gave them grandfathered status have not had to lodge their audited financial statements with ASIC. That all changed in August this year when the Senate introduced some last-minute changes to a particular Treasury Laws Amendment Bill. As a result, for financial years ending on or after 10 August 2022, all large proprietary companies, including those that were previously grandfathered, must prepare Tier 2 general purpose financial statements as a minimum. They must have those accounts audited, and then they must lodge them with ASIC. And the only exception is where some financial reporting exemption or relief is available to the company, for example, through a specific ASIC legislative requirement. And last but not least, the last few slides are for our not-for-profits that have tuned in today. Starting off with a reminder about new disclosures affecting not-for-profit entities since June. These disclosures relate to key management personnel, or KMP, remuneration. So in a not-for-profit context, your KMP would be the responsible persons and senior executives that are responsible for running the charity. So directors, board members, trustees, the general manager, chief operations officer, etc. Charities currently preparing general purpose financial statements under either Tier 1 or Tier 2 are not affected by these disclosures because they're already making these disclosures under AASB 124 and AASB 1060 respectively. There's also no change for small and medium charities that prepare special purpose accounts. These entities are not currently required to make these disclosures about KMP remuneration. It's only large charities that prepare special purpose financial statements that have more than one remunerated KMP that are impacted. These large charities will have to make the new disclosures applying either AASB 124 or AASB 1060. There's really no difference between the two standards in a not-for-profit context. The disclosures must be made for years ending 30 June 2022 and thereafter, and there's no need to show comparative amounts in the first year of making these disclosures. However, comparative information will obviously be required in subsequent years. Looking ahead to 2023, so from 30 June 2023, medium and large charities will have to make related party disclosures in their special purpose accounts. So charities should just start having a think about how their systems may need to change to be able to collate the information required to make these related party disclosures in the near future. Now, this is something I know is very close to Carmen's heart. The AASB has issued a discussion paper setting out its initial views on what simplified reporting requirements for smaller not-for-profits could look like. Why? Well, the plan is to remove special purpose financial statements as an option for certain not-for-profits in the future. Tier 1 and Tier 2 reporting requirements would be overkill for many of these not-for-profit entities that would have to migrate from special purpose to general purpose financial statements when this all happens. And so the aim is to develop a third reporting tier with accounting requirements that are easier to understand and apply, while ensuring the resulting financial statements remain useful to users. So who would be impacted? The proposals are aimed at smaller not-for-profit private sector entities that are required to prepare financial statements in accordance with Australian accounting standards for a regulatory authority or as directed under a legal document. A smaller not-for-profit in this context is one with annual revenue of between $500,000 and $3 million. However, the AASB is not setting reporting thresholds for the application of general purpose accounts by not-for-profit entities, as this falls within the remits of the relevant regulatory bodies. What will the simplifications look like? So first off, the intention is to create a standalone standard similar to the Tier 2 simplified disclosure standard. And the standard will be written in simpler language, and it will contain guidance on applying the accounting requirements. A number of areas have been simplified or are proposed to be simplified. For example, it's proposed that leases not be capitalized. Instead, they'll be recognized as an expense on a straight line basis over the lease term. Matching of revenue with related expenses will be allowed if there's a common understanding that the not-for-profit has to use the inflows for a particular reason or in a particular way. Under the proposals, not-for-profits will also have the choice to prepare consolidated financial statements or prepare separate financial statements that include information about the parent entity's significant relationships. So these are just a few of the more significant simplifications, but the discussion paper also discusses others, including employee benefits, impairments, financial instruments, and changes in accounting policies and errors. The discussion paper is out for comment until 31 March 2023. Based on the feedback, the board will then decide on next steps. So if there is support for the initial considerations, it's likely that the board will proceed to an exposure draft as the next step. If you want to get involved, and I strongly encourage that you do, there are many ways to do this. I suggest first having a read of the 12-page snapshot, which the AASB staff put together. It's just a high-level summary of the proposals. There's also a video that you can watch, and you can also register to attend an outreach session. Once you've done one, some, or all of these things, you can then complete a 15 or 20-minute online survey to give your thoughts and feedback to the board. The more feedback that the board gets, the better for the progress and outcome of this project. Carmen, that was very high level. Is there anything I've missed that you want to add?
No, I don't think so, other than to just add my very strong encouragement to please get involved. And any of you who will be coming to our not-for-profit session next year, we will be going into that in a lot more detail as well.
And finally, just as an FYI, the AASB has 2 not-for-profit post-implementation reviews on the go at the moment. So the point of a post-implementation review is to understand whether an accounting standard or a pronouncement is working as intended. The outcome of a post-implementation review can be no action, and that's because based on feedback, there are no issues in practice. It can be that the AASB puts out more educational material to address certain application of certain requirements, or the AASB may conclude that standard setting is required, and that would be to address widespread issues causing diversity in practice. So there's a PIR for income recognition in a not-for-profit context, which considers specific implementation issues raised by stakeholders since AASB 1058 and the not-for-profit specific guidance in Appendix F of AASB 15 were issued. And there have been quite a few implementation issues. I would think not-for-profits would be very interested in this particular post-implementation review, because with enough feedback, it could be that AASB 1058 is fundamentally changed or perhaps even rewritten. The second post-implementation review looks at other specific issues in a not-for-profit context, so control, structured entities, related party disclosures, and disclosures around compliance with Australian accounting standards. Both of these invitations to comment are open for comment until 31 March next year. So again, if you'd like to get involved, please do so using any of the means on the slide. And I think that's me. Yeah. Thank you, James.
Thank you, Carmen. Thank you, Michelle. Although there's no new standards, there's still things going on. There's always things going on.
There's always, I just wanted to say, there's always something going on.
That's right. And, you know, we've spent a lot of time over the last few years implementing all these new standards. We're going through the post-implementation stage now. But, you know, from a regulator point of view, as we saw with those, you know, ASIC reviews and everything like that, you know, the regulator's still looking closely at those new standards. So we, as businesses, should be getting in there, checking how we account for those transactions, making sure we're complying with the standard, obviously keeping up to date with any new information that's put out there by regulators, by accounting standard boards worldwide, and just making sure that everything's, you know, up to scratch in terms of how we prepare our financial statements and how we record our numbers. Now we'll move on to the Q&A section of the session this morning. There currently isn't any questions, so I'll give everyone a minute or two just to type any questions if you had one. And while we're waiting for people to enter any questions, we'll just talk a little bit about the bottom line. Now, the bottom line is a HLB publication that's written by Michelle Warren. The aim of it is to keep you in the loop with all the latest accounting and financial reporting developments and how they may impact your business. Issue 14 just got released. Michelle, do you want to have a few words about 14 and what it relates to?
Sure. I would point out the feature article, which is all about the AASB's discussion paper on simplified reporting requirements for smaller not-for-profit entities and what these could look like. It is just a discussion paper, but there's been a lot of thought being put into it. And we're trying to get as much airtime for this project as possible because it's I think it's an important one, and I think it's going to be extremely useful if this does happen. So yeah, I think it's 4 pages, high level overview of the discussion paper in case 12 pages is too long. And there's also, we do cover the recent amendments about classification of liabilities with specified conditions or covenants. And so if you're interested, perhaps go and have a read of that. And something to note is there's also been a recent amendment to AASB 16, the leases standard, that's specific to sale and leaseback transactions. It's not a huge amendment, but it could, I guess, change the accounting for some of your sale and leaseback transactions if you are involved in those types of things. And then yeah, we round out the issue with just a quick update on grandfathering to say that it is no more.
Thank you, Michelle. Now, there hasn't been any questions put in the Q&A box, so I think what we'll do is we'll go ahead and finalise today. Thank you to all the panellists. Thank you for your time today. And thank you, everyone, for joining us, and have a great rest of the day.